So you may be asking, why are people then investing in these companies when they show $0 in sales and have billions of dollars in losses? That is a very good question. I don't really know the answer to that. Welcome back to the channel, Shwazy Gang. In today's video, we're going to be doing something entirely different, and that is using my background in finance and my passion for cars and talking about one specific subject, and that is Rivian stock. Now, if you guys have been living under a rock for the last week and a half, you might not have heard that Rivian, which is an electric car manufacturer, went public and raised over $12 billion in cash, making it the largest IPO since 2014. Now, I'm not going to bore you with all the details of what an initial public offering or an IPO is. If you guys are interested in that subject, I'm happy to make more videos about it. But essentially, it is taking a company that was previously private, where not any of us laymen could invest in, and putting it onto a stock exchange where Joe Schmoes like you and I can now invest in the company and own a small percentage. Or if you happen to be a large hedge fund, you may be able to own more than just a small percentage of Rivian. But regardless, IPO gives you the opportunity to have ownership in a company and reap the benefits from stock price increasing, or when it comes to some companies, you can get a dividend depending on what type of company you're investing in. That is a very oversimplified explanation of an IPO, and it's a very tedious and complex process, but essentially it allows us to invest in these companies. Now, a lot of companies go public, Rivian included, to not only raise cash, which they did with their $12 billion of funding, but they oftentimes allow private investors to sell their ownership in the company and cash out. So that is another reason why a company may choose to go public, is access to funding and an exit opportunity for early investors. Now, what's crazy about all of this is you can actually determine the approximate value or market capitalization, or market cap for short, of a company based on the outstanding shares and the share price. Now, market capitalization isn't the perfect calculation to figure out the value of a company, but it gives you an idea of what the stock market thinks the company is worth. Meaning, if somebody had the money and they wanted to come and buy the company, market cap could be an indicator on how much the purchase price of that company would be. Now, to calculate the market cap, you multiply the number of shares outstanding in the market by the price of one individual share. Personally, I like to use Yahoo Finance because it gives you a lot of need-to-know information as soon as you pull up the ticker of a company. The ticker is the short acronym for a way you can look up a company using an exchange. So to give you an example, Rivian on today's date, which is November 18th, is currently trading at $123.38 as of close at 4 p.m. today. Multiplying the $123.38 by the number of shares outstanding gives you a market capitalization of $108.9 billion. That's billion with a B. Yes, you heard that correctly. Now, that number doesn't really mean much when you don't have anything to compare it to. I'm sure you're following along with where I'm headed here. To give you a frame of reference, Ford Motor Company is trading for $19.56. Now, keep in mind, the price of a stock doesn't really matter because it all depends on how many shares are outstanding. You can have a billion shares outstanding for a penny, and that's going to give you the same value as maybe a million shares outstanding, but it's selling for $10. So you really have to know both of those figures, just like a math equation, to figure out what the value of a company is. But keep that in mind, at 1956, Ford Motor Company is valued at a market cap of $78.2 billion. That is a difference of $30 billion, meaning Rivian, according to the stock market, is worth about $30 billion more than Ford, one of the oldest auto manufacturers in the entire world. That is what's so mind-blowing and why I decided to make this video today. I'm sure you have seen the headlines and maybe some of you understand these concepts, but I wanted to bring this to your attention because most of my subscribers and viewers are automotive fans, and they may not understand some of these details or even care to understand. But it is kind of crazy because it does impact the automotive world. What investors are implying with this valuation by buying stock that's worth $123 for a single share is they're thinking that this company is worth $108 billion. In fact, at one point this week, Rivian had a share price of $174, and it had an implied market capitalization of $140 billion, which made it the third largest automotive manufacturer by market cap after Tesla and Toyota. Higher than Volkswagen, higher than General Motors, and higher than Ford. Just for your reference, General Motors as of today has a market capitalization of $90.5 billion. So still, about $18 billion less than Rivian. Now, what does this really mean? Okay, so why is General Motors valued so low relative to Rivian, or why is Rivian valued so high? Well, in a perfect market, the stock price is based off of a variety of different things, one of them being the amount of earnings that a company generates. So to keep it simple and to break down exactly how the price of one share is calculated, let's say you have a pizza shop, and that pizza shop generates $100,000 in pizza sales every single year. Well, that's not just pure money that you get to put in your pocket. You have to buy the goods to make the pizza. The tomato, the dough, the cheese, the meat, everything that goes into making the pizza. Let's say that's $20,000 a year. That leaves you about $80,000. But that does not go into your pocket either, because you have to have employees that are able to make these pizzas. And let's say those employees cost about $30,000 a year. For simplicity purposes, because there's a lot more items that go into making a pizza or running a restaurant, let's say after all of those costs, you have about $50,000 left in your pocket. That would be considered your net income or earnings from the business. Now, to keep it simple for the purposes of this video, the way a stock price is calculated is it takes that earnings, divides it by the number of shares, and then multiplies it by an industry standard multiple. The way you find that industry standard multiple is by looking at other competitors in the industry. If a lot of them are trading at 10 times their earnings per share, well, then your company is likely going to be trading at that same amount. Here's where it gets tricky with Rivian. They have no earnings. When you're talking about a pizza business where you're making sales on pizzas and then you're paying your staff and all that, well, Rivian has had less than $1 million in sales. It's only delivered a couple hundred, if not less than that, as of making this video in November of 2021. It just started production in late September, and most of the deliveries have been to its own employees. Furthermore, when we're talking about earnings, Rivian has actually lost over $2 billion over the last 2 years. And in the third quarter alone, they're expecting a loss of $1.2 billion. So not only is this company not really generating any revenue, but their expenses are so high that they're actually losing money every single quarter. Now, the reason they've been showing losses is because it takes a lot of money to develop a brand new vehicle. I've even heard reports that established auto manufacturers like Toyota and Ford spend over $1 billion just to develop a regular gas-powered vehicle, let alone something that's pretty rare in today's market as an all-electric truck and SUV. Not only do they have to invest the R&D to develop this car, they also have to invest money in building a facility, hiring employees to produce this vehicle, and furthermore, they're going to have to establish retail shops in order to fix these vehicles when issues arise. That is a very expensive bet, and for that reason, they've been showing losses over the last few years. Now, you may be wondering, okay, if I have a pizza restaurant where I'm running sales of $100,000, but say I'm losing $1 million a year, how do I continue to run this business? Well, that's where you get outside investors, and that is how Rivian has stayed afloat over all these years. In fact, Ford actually invested money into the business and owns approximately 12% of Rivian. Amazon also invested into the business and owns almost 19% of Rivian. Amazon's plan to back Rivian was to fund a giant fleet of electric delivery trucks to make the company a little bit more green. Whether Rivian can deliver on that promise is up to anybody's guess. To give you a frame of reference on the average sales for a large manufacturer like Ford, they sold $35.7 billion in vehicle sales in one quarter. Tesla, which is also extremely high valued and the most valuable auto manufacturer, sold $13.8 billion in vehicle sales in a quarter. Rivian is less than $1 million. So if we were to use that price to earnings per share ratio that I talked about earlier, the stock price should technically be negative because there are no earnings in the business. In fact, they're losing money on a quarterly basis. Now, I don't want to knock Rivian entirely because at least they do have a few deliveries under their belt. belt. There's also another competitor, you may have heard of it, called Lucid Motors. And Lucid went public in July using a non-traditional initial public offering where they actually merged with a special purpose acquisition company known as a SPAC, which I can dive into in future videos, but it's essentially a blank check company that's already public, already went through the process of doing an IPO, and now you merge it with a private company, and therefore that private company is now a public company. But at the time that Lucid went public, it was valued based on that market cap at $24 billion, and it raised a little over $4.5 billion to fund its operations. That was with $0 in sales. Now, since then, Lucid has started delivering vehicles as of the end of October to its first several hundred owners, but it's still a very, very, very small player in this industry. So you may be asking, why are people then investing in these companies when they show $0 in sales and have billions of dollars in losses? That is a very good question. I don't really know the answer to that. No, in all seriousness, people are relying on the future profitability of these companies. People are trying to put money into something that's not Tesla. And even though Ford and GM are spending billions of dollars developing electric vehicles, a lot of investors don't see those manufacturers as the next Tesla. And I personally don't agree with that opinion. Both GM, Ford, and Stellantis in the next few years have invested a lot of money into developing some very interesting vehicles. I know a lot of people do not like the Mustang Mach-E, but it is a very formidable competitor against the Model Y. There is finally an alternative to Tesla. Same with General Motors' Hummer. You may not agree with the vehicle, you may think it's massively oversized, but it is an impressive vehicle. And even though very few people have gotten their hands on one, I expect that it's going to be a very popular car. Stellantis, or Dodge as we know it, is planning an all-electric muscle car that it will release in the year 2024. That will be something very much anticipated because we don't really have an all-electric muscle car here in 2021. To me, those are all reasons why Ford, GM, and Stellantis should be valued at the same amount or very close to Tesla, Rivian, Lucid Motors, which mind you is valued at $76 billion, essentially the same amount as Ford. But unfortunately, investors aren't seeing it that way. The flaw in that logic is you're expecting Lucid, Rivian, and any future competitor that IPOs to have future sales and earnings that are higher than Ford and General Motors. And yet here we are 15 years later, and Tesla's quarterly sales are less than half of that of Ford. Now, I'm not saying that there is going to be a revolution or a change, and I'm not saying Tesla isn't going to grow in sales. It most definitely will. But that doesn't mean that companies like Ford and General Motors are just going to stand back and see their revenue drop down to zero while Rivian, Tesla, and Lucid are growing off the charts. My argument is if you're going to value Rivian at over $100 billion in market cap, you should do the same with General Motors and Ford because they have just as many engineers, even better production capability, and many more resources than any of these other electric car startups. Now, I do think the market has realized this a little bit because the market cap of Rivian has declined since it peaked earlier this week. Like I said, currently it sits at about $108 billion. And, well, it's anybody's guess if it's going to go up or down. I think Rivian holds a higher value than Lucid at the moment because Rivian is backed by Ford and Amazon, which are both really large players in the industry. But that being said, the market cap is still a ridiculous amount when you look at the fundamentals of the business. Now, I am not an investment advisor, and I am not advising you to invest, buy, sell, or hold on any of these stocks. But I'm just giving you my personal opinion of this company based on my experience trading stocks in the past. For now, I am going to keep Rivian on my watch list. And I'm not talking about a watch list of a couple weeks or a couple months. I'm talking about a couple years. Until the company has proven that its sales are off the charts and people are happy with their orders and continuing to come back and recommend them to their friends, just like we saw with Tesla, I think it's a little too early to value a company at $108 billion. I don't know what the value should be, but to me it should be much lower than the established auto manufacturers of Ford, GM, and Stellantis. But I am curious to hear your thoughts on Rivian and Lucid Motors or the EV market in general. I know a lot of you are not fans of EVs, but whether you like it or not, we are transitioning into the electric vehicle space. And believe it or not, Rivian is not going to be the last IPO that has a ridiculous value. There's going to be more electric startups in the future, and they're going to continue invading the space. The question is, are they worth the value that they are trading at? Let me know what you guys think about Rivian down in the comments below. I'm curious to hear your thoughts. Do you think the company is worth what it is? Do you think it's going to be the Tesla killer, or at least a Ford and GM killer? Or do you think it's just going to be another established auto manufacturer when we look back at this video 10 years from now? If this is your first time stopping by, I am an automotive YouTube channel, but I do have a finance background, and that's why I decided to make this video. But hopefully you guys stick around, hit that like button, and subscribe to the channel. And also find me on Instagram and TikTok at Shwazy_. Until next time, everybody, don't follow my investment advice. Stay Shwazy, stay healthy, and have a wonderful day.